Welcome to this ACA Masters Tax Fundamentals class. My name is Hayley Farndon, and in this class we're going to be looking at corporation tax. This class is taken from the ACA Masters Tax Fundamentals video class, and the materials I will be referring to throughout the class are the ACA Masters Tax Fundamental materials. Further details of the video course and the materials can be found on the Tax Fundamentals page of the ACA Masters website. So going back to the different business structures, we're now focused in on the incorporated businesses where a company has been set up. So we have a separate legal identity for the company, which is separate from the owners, the shareholders. And we know that the company pays corporation tax on the income that it earns. So corporation tax, which we're looking at today, is for companies. Like individuals, companies can have multiple sources of income. As well as having a trade, the company may have property, so have property income, and have investments too. And when we look at the corporation tax pro forma in the notes, we can see the different sources of income that a company may have. So if we go to the ACA Masters notes and go to the corporation tax section, we can see we have the pro forma here clearly set out. So we have the separate sources of income. Trading income, which comes from running the trade or the business, property income from perhaps renting out a property, non-trading loan relationships, which is interest, which we'll come on to, and then chargeable gains, where a capital asset has been sold, and then dividend income. So we'll look at each of the sources of income, but it's good to understand that all of these sources of income are then added together to come to the total profits for the company. We'll firstly look at how trading income is calculated, and then we'll think about the non-trade loan relationships, which is the interest, chargeable gains, and then look at how we calculate the corporation tax liability for the company. We'll talk through an on-screen example that is similar to a scenario question that you'll have in the exam. At the end of this class, we'll then talk through some scenario exam-style questions. So as we said here, we've got the pro forma for corporation tax coming down to total profits. There's then a further deduction, qualifying charitable donations, which we'll also look at. And we then come down to our total taxable profits. We'll then look at how we compute the actual tax liability, the corporation tax liability, based on the total taxable profits. So a few key points to note down here. The accruals basis applies except for qualifying charitable donations, so there's no cash basis for corporation tax for companies. They need to use the accruals basis. And the taxable period is called an accounting period. And the accounting period for tax purposes cannot be longer than 12 months. So if you have a longer period of account, so an accounting profit and loss account of 18 months, for instance, this would be split up into a 12-month accounting period and then the additional accounting period for the remainder, so a 6-month accounting period. So you'd have two accounting periods, which is the taxable periods, within a period of account for accounts purposes. And we'll come on to these 2 points later about how we would apportion it, but basically you'd get your trading profits and then you'd time apportion this for the two different periods. You would also require two capital allowances calculations. So some good reminders here if we're looking at a longer period of account that we need to split into two for tax purposes. So we'll start by looking at the trading income calculation. When it comes to calculating trading profit for corporation tax, the principles are very much the same as what we saw in the trading income class. As we said, it's important to remember that the calculation of trading profit for corporation tax, trading income, is always on an accruals basis and never on the cash basis like we saw for income tax trading profit. There are a few key differences that we'll go through, but if you feel confident about the trading income class and adjustments for tax, then this will really help you in this class. And if you haven't watched the trading income class, then it's a good idea to go back and have a look at that first. So going through the adjustments, we'll go through these one by one in a moment, but just a couple of key notes. The main things that are missing from here that were within the income tax trading adjustments are the appropriation of profit or any adjustments for non-business use. Because the company is its own entity. It has a separate legal identity. It can't have private use of any asset, and there's no appropriation of profit because, again, the company can't take money out of the business for itself. And the profit is calculated before any profit is appropriated back to the shareholders, so before any dividends. The way that we're going to look how the trading income is pulled together is by looking at an example. So what we have here, we have our accounting profit. So the accounts drawn up show the profit and loss account coming down to the profit before tax of 494,500. We start with revenue, so sales, and we've got various costs and income receivable to come down to our profit before tax. And what we need to do for calculating the taxable trading profits, as we know, is start with the profit before tax and then make adjustments to come down to the trading income. So as we said, very similar for an unincorporated business. We start with a profit before tax and then add back any expenses already deducted or income already included. So within here, we can see all these expenses and income has already been included in arriving at the profit before tax of 494. So if it's disallowable, we'll need to add it back. And if it's allowable, we'll need to do nothing. So firstly, with cost of sales, we know that's a business cost of producing the goods or services. So we would do nothing here. We don't need to make any adjustments as it's tax deductible. And then the next one, depreciation. This is hopefully something you'll know by now, that depreciation is always added back to profit. It's disallowable. So we would need to add that back here as it relates to capital assets in the business. And we know that depreciation is added back, and then capital allowances is the tax relief given for capital assets. And we will look at how we calculate this for companies later in the class. And if we did have capital allowances in this question, we would then add another line down here in coming down to the trading income. As you can see on the pro forma down here, deducting capital allowances once you've added back the depreciation. The next one is wages and salaries. So wages and salaries are a tax deductible expense unless they're not paid within 9 months of the year end. So they're deductible on a paid basis, and you have to disallow any amounts not paid within 9 months. But in this information, there's nothing to suggest that these amounts haven't been paid, so there'd be no adjustment here. Similarly, with the office rent, this would be a cost for the company to rent an office in which to carry out its business, which is a business expense, so there'd be no adjustment required here, as we can take a tax deduction for the office rent. We then come on to property income. Property income is taxable for the company, but under its own category, the property income up here, which is one of the sources in the corporation tax computation. So what we need to do here, we need to take property income out of the trading profit and then put it within the property income. So what we're saying is, we're not saying it's not taxable, but we're saying it is taxable, but not within the trading profit. Taxable trading profit, it will be taxed separately under property income. Obviously, they will all be added up to get to the total taxable profits, but for the corporation tax computation, you do need to separate these different sources of income. And if there were any expenses related to the property income, then you could do a sub-working over here to work out what your property income would be. So property income, we're talking about where the company owns a property, which is then rented out. So it's held for investment purposes rather than for use in the business. The next one down is profit on disposal. So this would be an accounting profit on disposal, and it relates to a capital asset in the business. As it relates to a capital asset, we know that this income is non-taxable within the trading income. And what we need to do, we need to then calculate what we call a chargeable gain. And this then becomes taxable within the taxable profits calculation in the corporation tax computation. So a chargeable gain, what we look at here, we take the proceeds of the sale, and then we can deduct any costs, any associated fees with the cost of disposal, and we will then come down to our chargeable gain. We will look at the chargeable gains in a bit more detail. In the ICAEW Master's Notes, there's a really useful pro forma for the calculation of the chargeable gains, and we can see, as we said, that we start with proceeds, which is the proceeds received in respect of the disposal, and a note here that you would use market value if the disposal is to a connected party. So if it's a connected party, you wouldn't use any consideration they actually gave you, so they may have given you no consideration, but you'd use the market value. You can then deduct any disposal costs, so costs for selling the asset, such as agent fees, legal fees, etc. You can then deduct the base cost of the asset, which is the original cost of the asset, and then you can deduct any acquisition costs, so things like stamp duty would qualify as an acquisition cost, and then you would come down to your gain. Let's now look at a question, and with all the questions we should always read the requirement first. Requirement: what is the chargeable gain for Willow Limited? Willow Limited purchased an investment property in July 2020 for £250,000. The property was in disrepair and £12,000 was spent on redecorating the property. A further £50,000 was spent on an extension in June 2022. Willow sold the property for £350,000 in December 2025. So we've been asked to calculate the chargeable gain for Willow. So we know the chargeable gains calculation is proceeds. So the proceeds here, we are told £350,000. And then we can deduct the cost and any costs of acquisition or disposal. So we have the original cost of the asset here of £250,000, and then we need to consider whether any additional expenditure is deductible. So £12,000 was spent on redecorating the property. There would be no cost available here to deduct from the proceeds, as this relates to normal maintenance of the property. It hasn't enhanced the asset at all, it's just redecorating, so it's a revenue cost and would not add to the capital cost here, so we wouldn't take off the redecorating of the property. But in terms of the extension in June 2022, this will have enhanced the value of the property and is a capital cost, so we can take off the extension cost from June 22, which was £50,000, which would then mean our gain would be £50,000. So the answer here would be C, £50,000. So fairly straightforward calculation here, but just remembering to look out for amounts that can be deducted from the proceeds and amounts that can't be. For this example, we're going to assume that we sold the asset for £100,000, the cost was £60,000, and that we had legal fees on the sale of £5,000. So that gives us a chargeable gain of £35,000. We then need to take the chargeable gain and pull that into our corporation tax computation up here. So what we've done here, we've stripped out the profit on disposal and then calculated a separate chargeable gain, which is included up here, and the company will then pay corporation tax on all of these sources of income, so including the chargeable gain. So going back to our example, the next one down is charitable donation. We've got a note over here saying of the £500 donation, only £300 was paid in the year. So for donations for trading income, they are allowable if it's a local charity donation or gift, but we're going to assume that the donation here is to a national charity. And if it's to a national charity, then it's not a tax deductible amount, so we need to add the £500 back. But then we can take tax relief up here under the qualifying charitable donations for the amount that was actually paid in the year. So up here we would take a deduction for £300. So you can see we've stripped out the amount that went through the P&L, as this is not deductible for trading, but then we can take a deduction for any amounts paid. And when the final £200 is paid next year, we would then have a further deduction next year for qualifying charitable donations. And this is quite a common exam point to come up, so it is worth understanding how the qualifying charitable donations work. We've then got dividends received. It's a really important point to remember for corporation tax, that dividends are exempt and therefore not taxable. So what we need to do here, we need to take out the dividend amount received from the trading profit, which is £400,000. We would then expect to put the £400,000 up here, but as we know dividends are exempt, we will put a 0 in here. So a key point to remember for corporation tax, dividends received are exempt from corporation tax. The only time that you need to consider dividends is when you're working out your augmented profits, which we'll come on to later in this lesson. So the final 2 points we've got here in our accounts profits is interest receivable and interest payable. Now, for the purposes of the tax fundamentals exam, anytime you see interest receivable, bank interest or any income on savings, you'll always assume that this is going to be a non-trading loan relationship, an NTLR. So what you would do is you would strip out the non-trading amount. So we assume all interest receivable is non-trading, take it out of the trading income, and then tax it under the non-trading loan relationships source of income up here. So if you think about it in terms of why we would deem interest receivable from a bank account to be a non-trading loan relationship, so not to do with the trade, this is because the company's trade isn't investing money and then just generating the return from the bank accounts. The trade is likely to be buying and selling goods or providing services. So every time you see interest receivable in the tax fundamentals exam, assume that it's within non-trading loan relationships and you will be making the correct adjustments. For interest payable, this can be non-trading, so deducted within the non-trading loan relationships, or it can be trade-related. So if we had a trade-related loan, let's assume this interest here is for the loan to buy plant and machinery, then this would be trading interest payable and tax deductible, so we wouldn't need to make any adjustments here, and there'd be nothing to add into the non-trading loan relationships. But if, for example, we said actually this interest payable is on a loan to buy shares in another company, which relates to a non-trading activity, as the business does not buy shares as its trade, then we'd have to add back the interest payable, as that doesn't relate to the trading income, and we would take a tax deduction against the non-trading loan relationships. So we could do a sub-working here saying non-trading loan relationships, we know we've got a taxable amount of £16,000 from the interest receivable, and then we'd have the interest payable. We would take a deduction against the interest receivable, and this would then give us our total non-trading loan relationship income of 12,000. So we would then bring this 12,000 into our tax computation for corporation tax purposes instead. So you can see anything non-trade related we strip out and put within non-trading loan relationships. So here we've now considered all the adjustments here. We haven't factored in capital allowances, but we'll look at that next. But in this example, we'd then be ready to calculate our trading profits. So we'd sum up everything, all the adjustments from profit before tax, and that gives us trading income of 67,000. We would then bring that into our corporation tax computation up here, and we'd then be ready to work out our total taxable profits, which is within our pro forma here, total taxable profits, and we would then go on to work out the corporation tax liability. And we'll come on to that later in the class. What we'll do now is look at capital allowances. Now, in terms of the rules, the framework, and how capital allowances operate, it's very much the same for companies as it is for individuals. The only significant difference from an exam point of view is that when you're working out capital allowances for a company, you don't need to do any private use adjustments. And that's because companies can't use an asset personally, as we've said before, as that it's a company rather than a person, so there's no private use adjustments. You'll often see information in the exam questions that might make you think of doing a private use adjustment, but we must remember that companies can't personally use an asset, so there's no person to have a personal use adjustment for capital allowances. So the big thing here is anytime you see a car, for example, and it's used, say, 50% of the time for business, just completely ignore this and know that for capital allowances for corporation tax, you don't make any private use adjustments. Now, in terms of where we looked at how capital allowances are calculated for unincorporated businesses, this for companies now follows the exact same format. We start with the tax written down value, and we've got the main pool, we've got first year allowances, we've got the AIA. So first year allowances, again, 100% allowance, no limit, and the specific assets that qualify are the electric charge points, the cars with zero emissions that we saw before and are new, and also now for companies, any plant and machinery in an enterprise zone where the asset is new. And then for the AIA, similarly, 100% allowance up to £1 million. And again, we need to adjust for short periods, and this AIA can't be claimed on cars. There is one new point to flag, which is the full expense, which we didn't see in the pro forma for unincorporated businesses. And this is the type of first year allowance where essentially it's available for all brand new unused assets, but it can't be a car. So you often see this point coming up that they can't relate to a car, and it's only available for companies. So only for companies, not for unincorporated businesses. If a company buys a plant and machinery item that costs $300,000, the company could expense the full amount, get a £300 deduction. So you can see here, again, there's no limit on this amount. So it's very similar to the first year allowance. And another key point is that it's only for new assets. So if you have any second-hand assets, you can't claim the full expense. So then the disposals proceeds is the same as for income tax. You take the lower of the cost and proceeds, and that you will only have a balancing allowance on the cessation of business. And then you would have no allowances and a deemed disposal, and you get a balancing allowance. So that explains it here, or a balancing charge if you have a negative balance. And again, you can claim the balance if the pool is less than £1,000 for the main pool. Similarly, we would need to adjust the writing down allowances for any short periods, so the 18%. And also, if we had a shorter period, we would also apportion the AIA. So we'd work out that, say, for a 9-month period, we'd have $750,000 rather than the million for the whole year. And there's a few more notes down here. So with the full expensing, the plant and machinery, as we said, needs to be new and acquired after April 23, which is when full expense came in, and again, no cars. And one other key point to note here is that for assets where the full expense has been claimed, if any proceeds are received for that asset when it's disposed of, then an immediate balancing charge will arise. So if, for example, you had an asset where the full expensing was claimed of £100,000, and then a few years later it was sold for £30,000, a balancing charge would arise of £30,000. And in an exam question, you would be told if the full expense had been claimed on an original asset. And then the same as we looked at for income tax for the main pool, plant and machinery, fixtures and fittings, any vans, and then cars with CO2 emissions of less than 50. Let's now look at a capital allowances question. And we need to look at the requirement first to understand what we've been asked to do before reading the question. What is Oak Limited's trading income for the year ended 31st of March 2026? So we know we need to calculate the trading income for the year ended 31st of March 26. Oak Limited has tax-adjusted trading profits of £300,000 for the year ended 31st of March 2026. So we've got tax-adjusted trading profits of £300,000. 1st of April 25, it had a tax written down value of £45,000 on the main pool. On 1st of May 25, it purchased a machine for £22,000. So we need to calculate the capital allowances and then adjust the trading profits for the capital allowances. So we've been given the tax written down value brought forward here of £45,000, and we were told in the year there was an addition of a machine of £22,000. With the addition, we know this will qualify for 100% annual investment allowance. So we'd have the addition of £22,000, and then we'd have the annual investment allowance of £22,000. We'd then also have our writing down allowances due in the year, which we know are at 18%. So we can take the £45,000 and multiply by 18%, and we'd have capital allowances of £8,100 here. So the total allowances would be £22,000 and the £8,100, which is £30,100. So we can now deduct the capital allowances from adjusted trading profits, and that gives us trading income for Oak Limited of 269,900, which is answer D. So we would select answer D in the question. So a fairly straightforward question here, looking at capital allowances and then factoring them into the trading income computation for the company. And now we'll look at this question. So requirement, what are the capital allowances for each accounting period? JAM Limited prepares accounts for the 18th month period to 30th of June 26. The tax written down value of the main pool at 1st of January 25 was £102,000. JAM purchased a machine on 1st of April 25 for £30,000. For corporation tax, an accounting period cannot be longer than 12 months. So if we have a period of account that is longer, then we need to split this up into two periods. The first one being a 12-month period, so the 12 months to 31st of December 25, and then the remaining months will be their own accounting period. So we'll then have a 6-month accounting period to 30th of June 26. and we'll need a capital allowances computation for each period. So for period 1, we'll have the tax written down value brought forward that we're told is 102,000. We're then told there's an addition in that period because the addition was on 1st of April 25. So the addition was £30,000. And we know that the addition would qualify for annual investment allowance. So they'll get 100% allowances on this. And then they'll be entitled to the normal writing down allowances at 18% on the brought forward value of 102,000. So that will give them allowances of 18,360. We could then work out the tax written down value carried forward for that period, and that will be the opening tax written down value for the next period, so 83,640. There is no additions in the second period, so we've just got writing down allowances at 18%. But we do need to remember here that this is a short accounting period, so it's only 6 months. So the allowances that would be available would be 18% of the brought forward balance, but then times by 6 and divided by 12 to account for a 6-month accounting period. So for the second accounting period, we have allowances of 7,528, and for the first accounting period, we have the sum of these two, the AIA and the writing down allowances, which is 48,360. So the answer here would be A. The 12 months ended 31st December 25, 48,360, and the 6-month period ended 30th of June 26, 7,528. So just remembering here, when you do have a long period of account, that for corporation tax purposes, this needs to be split up into 2 different periods, which is of course different for income tax. When you're calculating trading income, you can have a longer period than 12 months. We've looked at a number of different adjustments that are required for trading income for corporation tax, and we also went through the adjustments in the trading income class, but we will just run through now the main adjustments that are required for trading income for corporation tax. So we know we start with the profit before tax. We always add back depreciation on loss and disposal and then deduct capital allowances instead. So the capital allowances are deducted down here and there's a separate working. For general provisions, specific provisions are tax deductible when expensed to the P&L, but general provisions are only deductible when paid. For wages and salaries, they need to be paid within 9 months of the year to be fully deductible, and pension contributions are only deductible on a paid basis. For third-party entertaining and gifts, these are generally disallowable. Gifts are only allowable to third parties if they are less than £50, advertise the company, and are not food, drink, tobacco and vouchers, and staff entertaining and gifts are generally allowable. Donations are generally deductible from trading income if they are to a local charity, and any non-trading expenditure is not tax deductible. Fines are generally not deductible unless they are parking fines incurred by an employee. Any capital related costs relating to assets are disallowable, and you claim capital allowances instead if it's a new asset. Repairs are generally allowable, but any enhancement expenditure for an asset is disallowable, and capital allowances could be claimed on this. For legal and professional fees, capital-related legal and professional fees are disallowable. For example, the legal fees for buying new assets, and the renewal of short leases where the lease is less than 50 years are specifically allowable. For lease cars, if the CO2 emissions are above 50, you must disallow 15% of the cost, and you need to add back any irrecoverable VAT on any of these above non-deductible items. And then we need to bring in any income that's not part of the trading income, so it's not included in profit before tax. So we deduct capital allowances. We can then deduct any expenditure not in the accounts, any pre-trading expenditure we incurred within the 7 years before the trade started, and then we know for interest receivable, so non-trading interest receivable, this is taxed elsewhere under non-trading loan relationships, and property income is taxed under property income. And then for profit on tangible fixed assets disposals, we would deduct this from the profit before tax and then calculate the chargeable gain as we saw earlier in the class. And that then brings us down to our trading profit and loss for corporation tax purposes. We're now going to look at how to calculate the corporation tax liability. As you can see from the notes, there are 2 rates here for corporation tax, 19% and 25%. And the tax rate depends on the level of augmented profits. So let's look at how we would calculate the augmented profits. So as you can see, the notes tell us that augmented profits are total taxable profits plus dividends from non-51% group companies. So generally, total taxable profits plus dividends received. So let's assume that our total taxable profits are £40,000 and we have dividends receivable of £5,000. That would then give us our augmented profits of £45,000. So if we then look at our notes, if augmented profits are less than £50,000, the tax rate will be 19%. So in this scenario, our total taxable profits of £40,000 would then be taxed at 19%, which would give us a tax charge of £7,600. And as you can see, the dividends were used here to work out the augmented profits, but it's still only the total taxable profits that are times by the tax rate. So let's now assume that our total taxable profits are £300,000 and our dividends are still £5,000. We can see that if augmented profits are greater than £50,000, the rate will be 25%. So that would therefore mean that £300,000 will be taxed at 25%. Total taxable profit. So here we would have a tax liability of £75,000. So if we just had everything below £50,000 was taxed at 19% and if everything above was taxed at 25%, then if you earned £50,000, the company would pay tax at 19%. But if the company earned profit of £51,000, the company would pay tax at 25%. As it's not like income tax, it's the whole amount that is then taxed at that tax rate. So what the marginal relief calculation says, that is if you have profits between £50,000 and £250,000, then your tax rate will gradually increase from 19% to 25%. So that if your profits are close to £50,000, the rate will be near to 19%. But if your profits are close to £250,000, then the company's tax rate will be close to 25%. And this is all based on augmented profits. But anything over £250,000 is taxed at 25%, and there's no marginal relief. So basically, there's three things to remember here. If the augmented profits are less than £50,000, the tax rate will be 19%. If the augmented profits are above £250,000, the rate the profits will be taxed at is 25%. And then if the augmented profits are between £50,000 and £250,000, then the tax rate will be 25%, and then they'll also get marginal relief. There's a calculation we need to know for marginal relief, and this calculation is not in the tax tables. So it's something you need to learn here. If we look at what we do have in the tax tables, we have the main rate of 25%, the small profits rate of 19%, and then we have the profit limit for the small profits rate, which is £50,000. So it does remind us here that we need to look at the augmented profits, which is helpful. And then we have the upper limit for marginal relief, which is £250,000. So let's now have a look at how we calculate marginal relief. And as we said, this formula is not in the tax tables. So let's assume now that we have total taxable profits of £200,000 and dividends of £5,000. So our augmented profits are now £205,000. Taxable profits will first be taxed at 25%, but then we can deduct some marginal relief. So we'll tax the profits at 25%, which is £50,000. We need to work out now what the marginal relief is. We know we need to take the upper limit, so upper limit here, which is 250,000. We then need to deduct the augmented profits, which we know are 205,000. So we take off 205,000, and that gives us £45,000. And then we need to multiply by taxable profits over the augmented profits. So let's now times by the taxable profits, which are 200,000, and divide by the augmented profits, 205,000. And then the next step is we need to multiply by the marginal relief fraction, which we know is 3/200. And we do have that fraction in the tax tables if you want to use this in the exam. So we would then take the answer from before, times by 3 and divide by 200. And that gives us marginal relief of £659. So we can then take off the marginal relief here from our £50,000 tax charge, £659, and that means the tax charge for the company for the period will be £49,341. So instead of the entire profit being taxed at 25%, it's all taxed first at 25%, and then we can take a slight reduction. And because our augmented profits here are quite close to £250,000, the marginal relief is quite low. So if we look at the blended tax rate here, we could take the tax and divide it by the taxable profits. We have a blended tax rate of 24.67%. So as we said, the augmented profits are quite close to 250,000. So the marginal relief is relatively low. If we now change this and say our taxable profits are now £60,000 and the dividends are still £5,000, our augmented profits are now £65,000. So when we come to the marginal relief calculation, we start with the 250,000, deduct 65,000, and then down here we multiply by the taxable profits over the augmented profits, and this gives us marginal relief of 2562. So we would update the marginal relief over here. We've got 25% tax on the 60,000, £15,000, and then we can deduct marginal relief and we come down to 12,438. So a blended tax rate of 20.73%. So you can see the rate here is much closer to 19%. So the closer you get to the £50,000 or augmented profits, the closer the rate will get to 19%. And when we go through some examples, it should be much easier to see how these calculations are working. And when you do the exam questions, you can do a sense check to check the rate is as expected. Are you close to the augmented profits limit and therefore the rate is closer to 25%, or are you closer to the lower limit of 50,000 and therefore the rate is closer to 19%? So just to summarise the calculation of marginal relief, we know it's the marginal relief fraction, which is 3 over 200 times the upper limit, 250,000, minus the augmented profits times taxable total profits over augmented profits. So it is quite a tricky formula. But one thing to remember is where there's no dividends from non-associated companies, this formula does get simplified. So if total taxable profits are the same as augmented profits, this fraction becomes 1. So we can therefore get rid of this part of the calculation, and the calculation just becomes the marginal relief fraction times the upper limit minus the augmented profits, which is the same as the taxable profits in our scenario. So what you're then left with is the marginal relief fraction, which is 3 divided by 200 times the upper limit minus the total taxable profits. So that definitely simplifies the formula if there's no difference between the augmented profits and the total taxable profits. So that's where there's no dividends from non-associated companies. There's one more important thing to note here for marginal relief, and that's that you need to prorate the limits for short accounting periods and also 51% associates. So if you have a short accounting period, so assume 6 months, you would then change the marginal relief limits from 50,000 to 25,000 and 250,000 to 125,000. And then you also need to prorate them for the number of 51% associates in the group. So the number of companies in the group under the same common control. So if, for example, here you had a 12-month accounting period, and then you have company A, which owns 80% of company B, C and D, that would mean there's 4 associates in total in the group, so you'd need to divide the limits by 4, and we'll see this as we go through the questions. We'll now look at this question. What is the corporation tax liability for Fly Limited? So Fly Limited has total taxable profits for the 9 months, so we need to take into account here 9 months ended 31st of March 26 of £150,000 and receives dividends of £25,000 from unconnected companies. It has no associated companies. So we know the limits for marginal relief are £50,000 and the upper limit is £250,000, but we need to prorate these limits for the 9-month accounting period, and we're told there's no associated companies. So we need to take these limits, divided by 12 and times by 9 to give us our new revised limits for the 9-month period. And we can see that the taxable profits are £150,000, and we need to add on the dividends of £25,000. So the augmented profits are £175,000. These do fall within these two limits, so marginal relief will apply. So we know that £150,000 will firstly be taxed at 25% and then marginal relief will apply. So we can now calculate the marginal relief. So you've got the marginal relief calculation here, which you won't have in the exam, but we can work through it in this class. We're going to take the upper limit minus the augmented profits. We then need to multiply this number by the taxable profits over the augmented profits and then times by the marginal relief fraction, which is 3 over 200, and we get marginal relief of £161. So we can then take off the marginal relief here, £161, and that gives us an answer of 37,339, which is answer D. So a good example here of where you have a shorter accounting period than 12 months and you need to prorate the marginal relief limits for the shorter period. Let's now look at this question. So the requirement, what is the corporation tax liability for Sky Limited? Sky Limited has total taxable profits in the year ended 31st of March 2026 of £86,000 and receives dividends of £20,000 from unconnected companies and £10,000 from connected companies. Sky Limited owns 60% of the shares in Cloud Limited and 35% of the shares in Rain Limited, and we need to work out the corporation tax liability. So we know from the tax tables that profits above £250,000 are taxed at 25% and below £50,000 are taxed at 19%. So the limits here, we've got £50,000 and £250,000, but we know we need to prorate these limits if we have a short accounting period and any associated companies. We have a full 12 months here, but we're told that Sky owns 60% of the shares in Cloud and 35% of the shares in Rain. That means there's one associated company here as Sky controls Cloud, so we need to divide the limits for two associated companies. So that means the new limits for marginal relief become £25,000 and £125,000. So we've got total taxable profits of £86,000. We've got the dividends of £20,000 we need to bring in, only bringing in the dividends from the unconnected companies. So that means the augmented profits here are £106,000. We now need to calculate the marginal relief. So we know that the £86,000 profit will be taxed at 25%. And then marginal relief will be available. So we now need to calculate the marginal relief. So the marginal relief calculation is here. You won't have this in the exam, but I've pasted it here so we can work through it for this class. So we need to take the upper limit, so 125,000, minus the augmented profits. We're then going to take this number, multiply it by the total taxable profits and divide by the augmented profits and then times by the marginal relief fraction, which is 3 over 200. So that gives us marginal relief of £231. So if we deduct £231 from the tax payable at 25%, that gives us tax payable for Sky Limited of £21,269, which is answer B. So when you're doing these marginal relief questions, always making sure you prorate the limits for the number of associated companies and also any short accounting periods. One final topic we need to look over before we look at the scenario questions is actually when a company files its corporation tax return and pays its corporation tax to HMRC. We've discussed how you calculate taxable profits and tax due, including marginal relief, but now we need to look at when the company is going to pay that corporation tax if it's due. The corporation tax filing dates and payment dates are all in the tax tables. So it's definitely one of those areas that you want to use the tax tables for in the exam. Obviously, the more you can learn, the better, as you don't have to look so much up in the exam, but they're very useful to have handy if you want to double check your answer. For companies, the corporation tax return is due to be submitted 12 months after the accounting period end, and a company can then amend that tax return within 12 months after that. With the first accounting period, they need to notify HMRC that a return is due within 3 months of the accounting. To work out the payment dates for companies, firstly, you need to calculate the augmented profits. We saw a calculation of augmented profits for marginal relief purposes, which is to take the taxable profits and then add on any dividends from non-associated companies. So here the definition is down here for what profits are within the payments regime. It's the total taxable profits plus dividends from non-associated companies. So once you've got your augmented profits, you compare the augmented profits to 1.5 million. If it's 1.5 million or below, then the company will be deemed to be a small company and the tax will be due 9 months and 1 day after the accounting period end. If the profits are above 1.5 million, then the company is being deemed to be a large company, and if they are above 20 million, the company is deemed to be a very large company. Where a company is deemed to be large, the first instalment payment is due 6 months and 13 days after the start of the accounting period, which will be the 14th day of the 7th month. And then the next instalments are due every 3 months, with the final instalment being due 3 months and 14 days after the accounting period end, which is always the 14th day of a month. And again, these payment dates are in the tax tables. Well, let's assume we have an accounting period started on 1st of January 25 and a 12-month period, so it ends 31st of December 25, 12-month period. And we're going to assume here that our augmented profits are £2 million and also that the total taxable profits are £2 million. So we don't have any dividends from non-associated companies here. So that means that this company will be paying at the 25% rate, as it's well above the limits for marginal relief. So the tax liability would be 2 million at 25%, which is 500,000. And as the augmented profits are above 1.5 million, this company will need to be paying by instalments. The first instalment is due 6 months and 13 days after the start of the accounting period. So 6 months and 13 days after 1st of January 25 is the 14th of July 25. And then the next instalment is due 3 months later, which is 14th of October 25, and then the next one would also be 3 months later, which is 14th of January 26, and then the final instalment payment is due 3 months and 14 days after the end of the accounting period. So 3 months and 14 days after the end of the accounting period would be 14th of April 2026. And the amount that is due on each of these dates is a quarter of the tax liability. So you would take the tax liability and divide by 4, and then each one would be exactly the same amount for this 12-month accounting period. So that then shows us how to calculate the instalment payments for a large company. There is a couple of exemptions here. So a company will be treated as small if it was not large in the previous accounting periods and profits are below 10 million in the current accounting period. So this one means if last year the company had profits of less than 1.5 million, and also this year the profits are below 10 million, then the company would be treated as small, and therefore they would pay their tax liability 9 months and 1 day after the accounting period end. And also they would be treated as small if their corporation tax liability is less than £10,000, so quite a small amount here. But you can see here we've got £500,000, but if it was only £10,000, then the company wouldn't have to pay by instalments. And that would be quite rare here to have a liability of only £10,000. It would only be if you had a lot of dividend income within your augmented profits. So in this scenario here, if we were looking to see if the company wasn't large in the previous accounting period, we'd have to look back to the year ended 31st of December 2024. So let's now look at the payment dates for very large companies. So in our example here, let's now assume instead of the augmented profits being 2 million, that they're 20 million and that the taxable profits are also 20 million. So that gives a tax liability at 25% of £5 million. The first instalment is due 2 months and 13 days after the start of the accounting period, which is the 14th day of the 3rd month. So that's 14th of March 25. They're then due every 3 months, so 14th of June 25, 14th of September 25. And the final one is due on the 14th day of the final month of the accounting period. So that's an easy one, 14th day of December 25. And the amounts would again be a quarter of the tax liability. So you divide this by 4 and the same amount will be due on each of the dates for the 12-month accounting period. So that then gives us our dates for very large companies. And you can see that these dates here are all earlier than the dates for large companies. So they're all 4 months earlier, which means that companies under the very large regime have to pay all their instalment payments before the end of the accounting period. So the final one is paid on 14th December 25 of the 31st December 25 accounting period. In terms of the profit limits here for payments on account, these profit limits are adjusted for short accounting periods. So let's assume here that instead of it being a 12-month accounting period and it ending on 31st of December 25, let's now assume that it still starts on 1st of January 25 but ends on 30th of June 25. So we've got a 6-month accounting period. We've got the large company profit threshold of 1.5 million and very large of 20 million. So we know that if companies breach these limits, they would be paid by the large companies' instalments payments or the very large companies' instalment payments. So if we've got a short accounting period, we then need to prorate these limits. So we'd need to divide these limits by 2 to account for the 6-month accounting period. So in this case, if the company for the 6-month period had augmented profits of above 750,000, they would be a large company and need to pay by the instalment payments for large companies. And if they were above 10 million, they would be a very large company and need to pay by these instalment dates here. Similarly, the profit limits are also adjusted for the number of associates at the end of the previous accounting period. So this is where you've got more than 50% common ownership. So if we have a company that is associated with 4 other companies, so therefore we have 5 associated companies, and that's by looking at the end of the last accounting period. And let's assume here we're back to the full 12 months. Then we would need to divide these limits by 5. So again, we'd start with the limits that we saw here, and then we'd take each of the limits and divide by 5 for the number of associated companies in the group. So in this case, that if one of the companies had augmented profits of above £300,000, they would need to pay by instalment payments for large companies, and above 4 million, they would be within the very large instalment payment regime. As with all taxes, there are penalties for late returns, which can be found in tax tables. We'll now look at some multiple choice questions. By which date is Apple Limited's final corporation tax payment due for the year ended 31st December 2025? Apple Limited has paid its corporation tax in quarterly instalments for many years. It has one 90% subsidiary. In the year to 31st of December 2025, Apple Limited has taxable profits of £620,000. In December 2025, it received exempt dividends of £270,000 from its subsidiary. So we know for looking at payment dates, we need to take the taxable total profits, which we're told in the question is £620,000. We then need to add on dividends from non-associated companies. So we know we have a dividend in the question, but this did come from an associated company as it's 90% owned here. So we wouldn't add anything on here to get to our augmented profits. So the augmented profits will still be 620,000. And we know for the profit limits that this company will be large if its augmented profits are above 1.5 million. So you might look at this and think, so they're not large as the profits are above 1.5 million, but we need to remember we need to adjust the profit limit for any other associated companies in the group, or if it's an accounting period that is not 12 months. So we do have a 12-month accounting period here, but we know we've got one 90% subsidiary. So we did need to divide the limit here by 2. So we divide by 2, and that gives us a limit of £750,000. So as the augmented profits are below £750,000, the tax will be due 9 months and 1 day after the year end, which is 1st of October 2026. So the answer here would be B. And if we had higher profits here, so if the profits were higher than 750,000, then the company would need to pay by instalment payments. Let's now look at this question. Requirement: by which date is Jasper Limited's first corporation tax payment due for the year ended 31st of March 2026? So we're going to need to work out if they need to pay by instalment payments or if they need to pay 9 months and 1 day after the year end. Jasper Limited has paid its corporation tax in quarterly instalments for many years. It has 2 associated companies. For the year to 31st of March 26, Jasper Limited has total taxable profits of £400,000. In December 25, it received dividends from an unconnected company of £150,000. Here we know our taxable profits are £400,000. We need to add on the dividends from the unconnected companies of £150,000, which means our augmented profits here are £550,000. We know that if the company have profits above 1.5 million, then instalment payments will be required. But we need to prorate this limit for any short accounting periods or associated companies in the group. We've got a full year to 31st of March, but we are told there's 2 associated companies. So we need to divide this limit by 3 here, which means if the company has augmented profits above £500,000, it will need to pay its tax by instalments. So this company, Jasper, will need to pay tax by instalments. As Jasper is large, it will need to pay its instalments on the 14th day of months 7, 10, 13 and 16, counted from the start of the accounting period. So the beginning of the accounting period is 1st of April 2025. First instalment payment is due on the 14th day of month 7. So month 7 is October, so the instalment payment will be due on 14th of October 2025. And the question has asked us for the first corporation tax payment, so that will be the first payment due. The next payment will be due on 14th of January 2026, and then 14th of April 2026, and then the final payment on 14th of July 2026. We're now going to look at a scenario question for corporation tax, which is XYZ Limited. So let's go down to the requirement and see what we've been asked to do. So compute XYZ Limited's taxable profits for the year ended 31st December 2025. Enter a number in each relevant box. If an amount is not taxable or no adjustment is required, you must enter a 0 into the relevant box. And in the exam, you will be given the boxes here to put your answers into. So we will look through each piece of information and then populate the boxes here. And remembering to put a 0 in the box if there's no adjustment required. So if we go back up to the top, and the best way to approach these questions is read through the information and then feed the information into the boxes as you read the information. So XYZ Limited, an unquoted trading company, prepares accounts to 31st of December and has two related 51% group companies. So this is key to note for a later part of the question when we're looking at tax payments. So in total, we know there'll be 3 associated companies, as we've got XYZ and then 2 associated companies. The draft accounting profits for the year ended 31st of December 2025 are 1.75 million. So we can put that number into the draft accounting profits box in the trading income calculation. The following items have been added or deducted in arriving at the draft accounting profit. So we're being told that these items here have already been deducted or added in calculating the draft accounting profits. So if we think that's correct, we need to do nothing. And if we think an adjustment's required, if we think they're not allowable, then we need to add them back here or move them to a different schedule if we think it shouldn't be taxed in trading income. So firstly, depreciation. We know straight away that depreciation is a disallowable expense for corporation tax, so that needs to be added back. And then loan interest payable, £12,000, note 1. Interest payable is on a loan to acquire an investment property. So this is not trading related interest, this is non-trading interest and should be taxed in the non-trading loans schedule up here within the total profits computation. So for loan interest payable, we need to add back the loan interest payable for our trading income calculation, and then we will take a deduction for it up here under the non-trading loans income. Property income, £24,000. Property income relates to an investment property. The property was rented out from 1st of July 2025, so halfway through the year, for £6,000 per month payable in advance. Due to financial difficulties, the tenant paid the rent for both November and December and January 2026. So we can see here we've got 4 months rent, we've got £24,000, and they haven't included the rent for November and December because it hasn't been paid yet. For corporation tax, we know that property income and trading income are always calculated on an accruals basis, so it doesn't matter if the income hasn't been received yet, it will still be taxable. So we need to make an adjustment here for this. And we know that the property income will also be taxed within property income up here rather than in trading income. So in the trading income, £24,000 of property income has been taken into account. So we need to deduct that from trading income. And then when we bring in the property income up here, we need to bring in £6,000 a month for 6 months rather than just 4, as we know at the moment they've excluded November and December from the property income. And then the next piece of information, the qualifying donation of £16,000 in the accounts comprises £9,000 paid during the accounting period and an accrual of £7,000. The accrual was paid in January 26. So for qualifying donations to be deductible, they need to be paid in the year, so only £9,000 will be deductible here. But we need to remove the £16,000 donation that has gone into arriving at the trading profits for our trading income calculation. So we add back £16,000 here, but we would then deduct only the paid amounts up here in the corporation tax computation. And then bank interest receivable, £4,000. Bank interest receivable is always a non-trading loan relationship income. So we would strip this out of trading income. So this is income, so we need to take out £4,000 of income, and then we would tax the income up here together with the non-trading interest payable. So we're bringing £4,000 up here. And then dividends, £25,000. Dividends received for companies are exempt. As we talked through in the class, dividends received for companies are exempt. So we would need to deduct the dividends here. So take out £25,000 as this is not taxable within trading income. And when we bring it in up here for dividends, we would bring in a zero amount as we know they are exempt. And then we have, in addition, the following items have not yet been included in the accounts. So here, if we think these are deductible items, we will need to make an adjustment. And if we think they are not tax deductible, then we won't need to do anything as they haven't been included. A staff Christmas party costing £2,000. 15 employees attended the party. We know that for calculating trading income for corporation tax, staff entertaining is allowable. So we can deduct £2,000 here from our trading income. The question has told us how many employees attended the party, but this is irrelevant for corporation tax as we know staff entertaining is deductible. Because we're giving the information on the question, it's an easy trap to fall into here to calculate the cost per person and then look at this and see whether it's below £150 per person. But as we know, this is for the purposes of looking at taxable benefits for employees, and if the cost is lower than £150 per person for an annual staff function, then this would be an exempt benefit. But here we don't need to worry about the cost per person. And then the next one, the company did not purchase any assets in the year, but it had a tax written down value on the main pool of 1st of January 25 of £12,000. So it hasn't purchased any assets in the year, which means there won't be any AIA or first year allowances available, but it will be able to claim 18% allowances on the main pool balance brought forward. So the capital allowances due will be £12,000 times 18%, which is 2,160. So we've now looked at all the information for this part of the question. We can sum up our amounts to come down to our trading income. So that gives us trading income of 1,785,840. And we can then feed the trading income into the corporation tax computation up here. So 1,785,840. And then we can sum up the total taxable profits for the company. So that gives us 1,804,840. So that's the total taxable profits for XYZ Limited. So as you can see, fairly straightforward going through the scenario question, just feeding in the information, one piece of information at the time. And as you can see, it's important to know which items are tax deductible and which items are not deductible here, and also which amounts need to be taxed or deducted under other sources of income. We can now go on to look at the second requirement of the question, and we've got the boxes down here to complete which are relevant for part 2. Requirement: complete all the boxes and state the first day by which any corporation tax should be paid in relation to the year ended 31st of December 2026. So we're now looking at the year after the year we've just calculated the profits for XYZ Limited. Input the date in the format date, month, year. So in the year ended 31st of December 2026, XYZ Limited expects taxable profits of £1,225,000 and is expected to receive exempt dividends of £200,000 from unrelated UK companies and £95,000 from an unrelated German company. So for our augmented profits calculation, we know we're going to need to start with total taxable profits, as shown in the pro forma here. So total taxable profits are 1,225,000. We then need to add in any dividends from non-51% companies. So we can see here that these dividends received are clearly from unrelated companies. So we would need to add in here the dividends to get to our augmented profits. So that then gives us augmented profits of 1,520, so 1.5 million. And we now need to say the payment date, so the first date by which any corporation tax should be due. We have augmented profits of 1.5 million, and we know the profit limits for a company to be large is 1.5 million, and to be very large it's 20 million. But we need to divide these limits by the number of associates in the group and also reduce down for any short accounting periods. We have a full 12 months here, but we do need to divide these limits by the number of associated companies, which is 3, which we read at the start of the question. So if the profits are above 500,000, there will be a large company. And if their augmented profits are above 6.6 million, they will be a very large company. So we can see here that the augmented profits are above 500,000. So XYZ Limited will need to pay by instalment payments. They wouldn't have to pay by instalments payments if the year before they weren't large. But if we look back to the total taxable profits for the year before, they were clearly above this level of profit. So they had profits of above 500,000, which means the augmented profits will be above 500,000. So they would have paid by instalment payments the year before. So that means this company must pay by instalments for the year to 31st December 2026. The first instalment payment is due for large companies 6 months and 14 days after the start of the accounted period, so the 14th day of month 7. So month 7 would be July. So the first instalment payment date would be due on 14th of July 2026. So we've now completed all the boxes for XYZ Limited and we've calculated the payment date. So that brings us to the end of this question, and you can see that when you break the scenario question down into smaller parts, it is fairly straightforward to work through. And as we're given the pro forma in the question, this prompts us to fill in each of the boxes, so this is helpful here. That brings us to the end of this Tax Fundamentals corporation tax class. We've covered quite a lot in this class. As usual, I would suggest going back over the workbook chapter in respect of corporation tax, having a look at the question bank and trying more multiple choice questions. And then once you're comfortable, moving on to look at the remainder of the scenario questions and really practice the marginal relief calculations and the instalment payment dates calculations, as these are probably the most fiddly aspects of corporation tax that will come up in the Tax Fundamentals exam. So if you can master marginal relief, payments, as well as calculating trading income for a company, you'll be well set up to answer the corporation tax scenario question in the exam.